Hi, welcome to Bookie. Today we will unlock the book A Random Walk Down Wall Street for you. Let's first tell you a story. Most of us think of the Netherlands when we think of tulips. But as a matter of fact, before its introduction to the Netherlands, the tulip was a rare plant native to Turkey. How did the tulip prevail in the Netherlands and become a representative symbol of the country? There is something legendary about it. In 1593, a botany professor brought tulip bulbs from Vienna to Leiden, and during the subsequent decade, tulips became a popular but expensive flower among the Dutch. Later, a non-lethal virus called mosaic infected some of the flowers, causing stripes in contrasting colors to grow on the petals and giving the flower a bizarre beauty. The Dutch highly appreciated the bulbs, and within a short time the public had developed a shared passion for the flower. Dutch aristocrats, citizens, farmers, sailors, houseboys, maids, and even chimney sweeps were all happily engaged in the tulip business. Tulip prices rapidly increased, and the more exotic the bulbs, the higher the price. In the final years of the tulip craze, people began trading jewelry, land, and personal furniture for the bulbs. There were even financial instruments on the market to help tulip speculators. These were the crazy times. But it turned out to be the final stage of the tulip mania. In January 1637, prices for tulip bulbs rose by a factor of 20. By February, prices nosedived and continued to be in free fall. The market losses snowballed, and tulip bulbs lost their value, becoming almost worthless and selling at a lower price than ordinary onions. This is a familiar story, isn't it? The tulip bulb craze was the world's first documented financial bubble. Since then, the Wall Street crash of 1929, the Japanese property bubble of the 1990s, and the subprime mortgage crisis that swept the world in 2008 have been nothing more than repetitions of the famous tulip mania. We fall into the same trap over and over as we go from reason to frenzy. Why have there been so many speculation frenzies even though we see the same story play out again and again throughout history? How should we as investors avoid investment traps and obtain positive returns in the stock market? A Random Walk Down Wall Street gives us the answer. Before getting into the book's content, we'd like to explain its title, A Random Walk Down Wall Street. We are all familiar with Wall Street. It is the financial center of the United States. So, what does random walk mean? It actually has two meanings. First, it refers to the ease with which readers can navigate the financial markets as if on a leisurely stroll down Wall Street. Second, random walk signifies that short-term fluctuations in stock prices cannot be predicted. Therefore, the author suggests that we be wary of investment experts who claim to be able to predict the direction of share prices. The author also believed that buying and holding index funds will yield better returns than buying and selling individual stocks or actively managed funds. We'll talk more about that later. The author of the book, Malkiel, is an outstanding professional investment manager and a scholar with profound accolades. He received his Ph.D. from Princeton University and later served as director of the Bendheim Center for Finance and chair of the economics department at Princeton. Malkiel also served as a member of the Council of Economic Advisors and was dean of the Yale Business School for 8 years. In addition to these notable positions, he sits on the boards of several large well-known companies. He is also known to have held onto his favorite investments for 30 years, making above-market profits. Next, we will explain the core ideas of A Random Walk Down Wall Street in 3 parts. First, are Wall Street elites reliable? Second, ways to reduce investment risks. Third, 3 types of random walk investment methods. Let's start with the first question, are Wall Street elites reliable? You may wonder, why couldn't Wall Street investment analysts and securities traders make predictions ahead of the financial crisis, like weather stations before a storm? Aren't they professional? To address this question, Malkiel quipped that blindfolded chimpanzee throwing darts at the stock listings can select a portfolio that performs as well as those managed by the experts. This is his way of asserting that the Wall Street elites aren't reliable. To judge the Wall Street elites accurately,